If I were starting over today with $0 invested, I'd buy exactly 3 ETFs, not 5, not 10, 3, because most portfolios don't fail due to lack of options. They fail due to complexity. This strategy works because it focuses on what actually drives long-term results. These 3 ETFs cover the 3 most important jobs a portfolio needs to do: grow wealth, stay stable through volatility, and generate income that keeps you invested. And stick around until the end, because after we break down each ETF, I'll show you how I'd actually allocate them at different stages of life. Whether you're in your 20s, your 40s, or approaching retirement, that allocation part is where most investors either get this right or completely mess it up. Before we dive in, a quick note: these picks are based on long-term investing principles. As of late 2025, markets change, expense ratios adjust, and yields fluctuate, so always check current details before investing. The strategy matters more than the exact numbers, but staying informed builds confidence. The first ETF I'd buy is a broad market fund, because this is the foundation of everything. My pick here is VOO, which tracks the S&P 500. This ETF owns the largest and most profitable companies in America, businesses with pricing power, global reach, and long histories of earnings growth. VOO's biggest advantage is efficiency. Its expense ratio is just 0.03%, which means almost every dollar you invest stays working for you. Broad market ETFs succeed because they capture long-term economic growth, innovation, and rising corporate profits without needing to predict which company will win next. The index adjusts automatically by removing weaker companies and increasing exposure to stronger ones. VOO isn't the only option. IVV, SPY, or even VTI can play the same role. The point isn't the ticker. The point is owning the market itself and letting compounding work over time. The second ETF I'd add is a growth-tilted fund to increase long-term upside. My pick here is QQQM, which focuses on companies reinvesting heavily into innovation, technology, artificial intelligence, cloud computing, and innovation-driven platforms. This is the accelerator in the portfolio. QQQM has a slightly higher expense ratio, around 0.15%, but historically it has delivered strong long-term returns by concentrating on companies driving future growth. Growth ETFs are more volatile and they pull back harder when tech cools off, but over long periods, faster growth earnings tend to compound more powerfully. QQQM isn't the only option here. If you want broader growth exposure with lower fees and less NASDAQ concentration, SCHG or VOO are excellent alternatives with expense ratios closer to 0.04%. Different flavor, same role, emphasizing growth. The third ETF I'd buy is a dividend and income fund, and this one is controversial for some people, but hear me out. Investing success isn't just about math, it's also about behavior. My pick here is SCHD, which focuses on high-quality companies with long histories of paying and growing dividends, strong cash flow, and disciplined payout ratios. With an expense ratio of around 0.06%, it's also very efficient. Its current yield is roughly 3.6 to 3.8% right now, but the real value isn't the yield alone, it's sustainability. SCHD provides steady income, gives you cash flow to reinvest during market downturns, and acts as a psychological anchor when markets get uncomfortable, which they will. What happens when tech pulls back sharply? This is the fund that keeps paying you anyway. If you prefer dividends with more growth emphasis, funds like DGRO or VIG can also work well. Same job, slightly different emphasis. Now let's address something that confuses a lot of investors: overlap. Yes, there is overlap between these ETFs, and that's intentional. Overlap isn't a flaw when it's deliberate. VOO gives you broad exposure to the market. QQQM intentionally increases exposure to innovation-driven companies. SCHD intentionally emphasizes quality and cash flow. You're not duplicating risk. You're weighting what you want more of. Overlap simply means you're expressing priorities, not making a mistake. And yes, during periods when growth dominates, the dividend portion may lag. That's the trade-off for better stability and protection when markets reverse. What makes these 3 ETFs work together is that each one plays a different role. The broad market ETF builds steady long-term wealth. The growth ETF increases upside during innovation cycles, and the dividend ETF smooths volatility and supports disciplined investing. On their own, each has weaknesses. Together, they balance each other. Now let's talk about how these ETFs might be weighted at different stages of life, because this is where strategy becomes personal. I'll put these numbers on the screen so you can screenshot them. If you're younger, in your 20s or 30s, time is your biggest asset. You can afford volatility because you have decades ahead of you. At this stage, most investors should lean heavily into growth. A simple framework might look like around 60% in a broad market ETF like VOO, 30% in a growth ETF like QQQM or SCHG, and 10% in a dividend ETF like SCHD. The goal here isn't income, it's maximizing long-term compounding while emotional pressure is lower. In your late 30s and 40s, balance starts to matter more. Careers, families, responsibilities increase, and emotional volatility becomes just as important as market volatility. This is where many investors benefit from dialing back pure growth and adding stability. An allocation closer to 50% broad market, 25% growth, and 25% dividends can still grow aggressively while smoothing the ride. As you move into your 50s and 60s, reliability and capital preservation become more important. You still need growth. Inflation doesn't disappear, but consistency matters more. At this stage, something like 40% broad market, 20% growth, and 40% dividend income can reduce drawdowns, increase cash flow, and protect what you've already built while still allowing growth. These aren't rules, they're starting points. Everyone's risk tolerance and goals are different, and this is a US-focused equity portfolio, which is excellent for long-term growth potential. As you advance, you may choose to add international stocks or bonds for broader diversification depending on your situation, but you don't need all of that on day one. The real takeaway is this: start simple, invest consistently, review annually, and let compounding do the heavy lifting. VOO, QQQM, and SCHD aren't the only choices, but they form a flexible, intentional foundation you can grow with for decades, and most importantly, it's a portfolio you can actually stick with. If you found this video helpful, hit subscribe. I break down investing strategies like this every week. I really appreciate you watching. If you're not sure what to watch next, check out another one of my videos right here. Take care, and I will see you next time.